Well, it's a great question. There's nothing wrong with an investment in bonds. It's a perfectly reasonable part of an asset allocation. But we are in an environment where no one can predict where interest rates are going to tomorrow or the day after. But one thing's for sure, there's a lot more room for them to go up than to go down. And as yields go up, the price of a bond goes down. Many people in the past, if they held bonds, invested in individual bonds where the primary risk, where they expected to hold them to maturity, and the primary risk was credit risk or giving up opportunities to invest in something else. Now there's been a huge growth in bond funds and to some degree a significant growth in bond ETFs. When you're invested in a bond fund, that may be a perfectly reasonable investment, but if interest rates start to go up, that bond fund will lose value, most likely, and it will turn over, and the manager of that bond fund will turn over the investments. So that will be a loss that won't be regained unless the market reverses and bonds rise. There will be no opportunity to hold your bonds to maturity and be satisfied with that. So investors may suddenly wake up and see a significant loss. Now bonds are less volatile than stocks, but certainly losses of 5 and 10% are perfectly reasonable to expect, and investors should be prepared for.
That they're not necessarily safe is what is often perceived.
Well, they may be safer than many investments, but they're not riskless. And that's a very important point for investors to realize, that they're not that a bond investment, certainly a bond fund investment, has risks, and you should evaluate whether those are risks you're comfortable in taking.